Well, good morning. Indeed, you can see the optimism returning to the market. This is one hell of a crowd. I was fascinated to see the selection of this image. Butterfly for a bunch of credit people, loans. So, I mean, just thinking while you were going through that, what is it? First of all, is it supposed to portray that credit loans are actually something to do with beauty? My gardener sees butterflies as simply the after effects of a plague of caterpillars. Is that what he's trying to say about you? Is it meant to represent the attention span of loan investors? Perhaps it represents the nature of their analysis of the loans. However, you've got to remember, butterflies actually only live for one purpose. That's to make love and die. Perhaps that's what he has in mind for the credit markets. But the good news is they appear in spring, and they vanish when the weather turns adverse. Perhaps that's what he's really trying to tell you. Anyway, with that aside, I'll move on to the slightly more serious stuff. CLOs back for a while. So let's first of all just think about what we do for a trade. That's the product. It relies on the integrity and competence of investment banks, rating agencies, relies on complex legals, often with derivatives, complex structures. And I did some work on Northern Rock. Their final product had 11 layers of debt, 3 currencies, swaps, derivatives of every kind. Right? Nobody understood it. And yet people bought that at 8 basis points because it was AAA, of course. It was fine. And, of course, you've got these nice offshore jurisdictions to get the taxes to work. So that's not a particularly nice description of a product. And then you get paid 20 basis points for sticking the money in, which hardly rewards you for the analysis of what you've done. So, of course, you don't do the analysis. But it's not surprising that that business model was open to abuse and problems. So let's move on from there. Upswing, a few numbers. Bear in mind the CLO market isn't a nice, easy market to talk about. You've got all kinds of adjacent products popping up nowadays. Secured notes of one form or another at the banks, private CLOs, SIVs and things which actually aren't more than minutely different than the CLO market, so the numbers are a bit vague. But there's no question it's definitely coming back. But that gives you an idea of where it was at the peak, roughly. And that's where it is last year. So it's down quite a bit, actually. So against that background, you're definitely here because you're optimistic. And that's what people are sort of pitching for this year with great uncertainty. Clearly, half a dozen more larger CLOs, and you'll go ripping through those numbers. But that's the scale of it. What you haven't got is an epidemic or anything that looks really good. There's lots of opinion surveys. If you go around and pick up the literature around in the exhibition hall, you'll see that on the whole, investors are moderately optimistic, mildly optimistic. They're not really enthusiastic. But pricing's drifting back from 250 odd to 125, and investor demand's definitely uphill, so not at all bad. Of course, you do have unexpected events in all markets. Anyway, we'll move on. So, why did this lot all go down? Well, actually, it's quite clear. I mean, CLOs were just part of excess leverage everywhere. We had monoline, heaped on investment bank, heaped on CLO, heaped on leverage loan, end-to-end leverage ratios, actually, when you multiplied them through 100 to 1. Again, not surprising, there were problems. We had far, far too much debt. And in many ways, we still do, which I'll come back to later. Dodgy product. We've read about the fabulous fab. We've seen some of the stuff that happened. Integrity went away in this market with the excesses. Not universally did it go away, but there were enough examples of people doing dodgy things all the way up and down that capital structure to guarantee you would have a problem. And lots did happen. You had buyers who became completely indiscriminate. Caveat victim rather than caveat emptor became basically the approach of the market at the peak. people piled in to get miserable returns for consuming very difficult, complicated products. Some of those came back to bite, the cubes, the squareds, the synthetics. Most of those had very, very bad outcomes and predictably would have had it with any degree of skepticism applied, but it wasn't. So people got away from doing those kind of things. Then you had the valuation difficulty. Nobody knew what these assets were worth, which confused the bank's balance sheets even more. Many people didn't know how to report them. You'd got different accounting standards. That wonderful language about unobservable inputs, which most of us had previously imagined got something to do with bowel problems. You had AIG's collapse, the credit default swap nonsense that was going on, the triangulation of Goldman's and AIG and monolines. It was just awful. You've got the investment banks behaving in a very greedy manner. Again, variable behavior, but there was plenty of bad as well as plenty of good. Hardly any money to be made out of investing in this at the peak. Didn't deserve any level of risk or difficulty when you're making a few basis points. And then we had, of course, this wonderful myth of AAA, as the rating agencies proved for a fee willing to rate all kinds of stuff AAA, and actually destroyed the value of that rating in terms of its investor appeal quite strongly. It almost became a point of if it said AAA, you should watch yourself. That's how bad it got. It's interesting, though, nobody's come up with better solutions to many of the issues here. And those issues need to be resolved over time ahead if this asset class is to really thrive. So this is some stuff I nicked from Babson because they seem to be better at this information than me. Just to show what happened. Again, what happened to the spreads. They went screaming upwards and they come screaming downwards. The interesting thing I find is the word at the top, historical. Remain wide of their historical norms. I mean, I don't know whether it's just me, but I don't think 20 basis points is a norm. I think 20 basis points is an aberration. In most of financial history, things don't trade at that sort of level. So I think pricing long-term will definitely be higher than it was. At the moment, we seem to be living in this incredible, calm, happy world where butterflies flit around and there are no problems. I don't think it's right. I think we have a lot of risk out there, and I'll come back to that shortly. But at the moment, this would encourage you to pile into the class because you wouldn't believe in defaults and you wouldn't believe in the fact that spreads will widen. So what drives the future for CLOs? Lots of things. Basics are all there. Risk, return, liquidity, regulation, those are the big tickets. All of them open to a lot of discussion. That's definitely happened. I mean, by the end of last year, anybody could understand a CLO for the first time ever. It took about 5 minutes to grasp the CLO structures that were in the market. The industry had become de-skilled, blessedly. That's good, I think. Simpler structures should prevail. The complexity is associated with greater failure is absolutely obvious. The complexity isn't worth its cost is virtually always true. So I think simpler structures will help the class. They'll diminish the opportunity to make super profits because you won't be able to play strange games, but they will enable you to make good, steady gains. And they will actually give a reasonable rate of return on simple structures and non-spectacular leverage.